stream with Dom one time. I remember his thing kept going off, and he's like, "I can't
Uh,
hear it." I was like, "I can hear it," and then people in the stream were like, "I can hear it." And I was like, "Great,
yeah.
guys, what's going on? Welcome back to Wolf. Welcome back to another stream. We're going to be talking about the markets as we always do. We get the S&P up like 0.5% in the last day. Bitcoin's relatively flat, sitting around 62.7. Last I checked, Robert just informed me that oil's making a move right now, so the market's kind of holding its breath a little bit. We've got a big day tomorrow for the SpaceX IPO. We've got Anthropic IPO potentially before Halloween. We've got OpenAI end of year. So it's going to be kind of a crazy year, I think. All the 4-year cycle people are kind of paying attention to that. That would be putting Bitcoin in line with some pumping toward end of year, it looks like, as well. And so a lot kind of going on in the macro world. We're going to talk about it. If you haven't already, please do take a second, repost the stream as we get into it. Give a follow to Robert as well. And big shout out to Public as well for sponsoring the stream today. While we're going throughout the streams, Robert will be toggling in and out of various charts and stuff like that. Some of them will be the Public brokerage. So just big shout out to them for sponsoring the show. We do have a paid relationship with them as our headline brokerage sponsor. They're an investing platform for those who take it seriously. Whether you're a passive or active investor, you can use AI and a wide range of asset classes from stocks and bonds to crypto and options to build a portfolio for the long haul. So if you want to check them out, you can find a link below in the description. Or if you're watching on X, that'll also just be in the tweet below the stream. So either way, if you guys want to click into that and find out more and check it out, highly recommend you guys do so. Big shout out to them for sponsoring as always. And Robert, tell me a little bit about what's going on in the markets. What's got your eye? You mentioned a second ago oil. What's going on?
Yeah, we have new geopolitical issues going on with war with Iran, unfortunately. So we also have a hazmat situation at the Pentagon where I guess apparently it's being evacuated, like multiple floors of the Pentagon.
I saw something about this. Yeah, I read something about this.
So I don't know if that's related, but 2 days ago we got strikes on Iran. I think, did we start at this? It's so hard to keep up. I think we started at this time. Yeah. And then they retaliated. And then, it's been kind of the past 2 days. We gotten definitely some heat back into that situation. So we have oil moving again. Barely. Barely. Not like it was. Today actually down from yesterday's close, which is kind of weird given the fact that last night, or right after the market closed yesterday, we got even more strikes, and then they of course retaliated. And then earlier today we got Trump threatening an invasion of Karg Island, which is their major oil export hub in the Persian Gulf. 90%, I think, of their oil gets exported out of Karg Island, and it's an island. And to try to invade it, boots on the ground kind of situation would be from the military people that I trust, and listen to. It would be pretty catastrophic to try to do that. So, the fact he's bringing that up again is interesting. But yeah, oil's not really moving like it was. In the beginning of the war, you would get like one of these kind of, fake Barack Ravid headlines, and oil would plummet, or the other way, you would get a headline of, new missile strike and, ballistic missile launch from Iran going to Kuwait, whatever, and oil would rip, and you get like a 3% move in 5 minutes. We're not getting that anymore. I think the oil market's very sedated from all the fake back and forth. Some, not only fake back and forth, not only the like market manipulation, Barack Ravid stuff, but just kind of the turmoil, like the constant back and forth tension. I think it exhausted me. I was trying to keep up with it in the early part of the war. And, it was like a full-time job, literally. Like it took like 5 hours a day to try to keep up with every little strike and every little, development and movement of this, carrier strike group. And this, oil export hub it was taking too much of my time. And so I just kind of gave up on caring and tracking and spending any time. And I think, a lot of other not only oil traders, but and when I say oil trader, I don't mean, one of the oil traders at Shell, or BP. They're still active, but the kind of like retail oriented people that were in the oil market. I think that they're kind of like me, and they just it's been exhausting trying to keep up with it and trying to care, right? Either one way
Mm,
or another, like bearish, bullish, almost kind of doesn't matter. I think that there's just like a level of kind of exhaustion. And you see that, if you look at if you look at CL, front month WTI, and then you look at like the volume, it's just been plummeting. So we'll go to the daily. You can see the moving average here, I think is a 14-day moving average. And you can see it's just been plummeting the volume.
wow.
So yeah, this is what happens when you whipsaw markets, right? Like you just get people exhausted and they
Yeah.
don't want to participate anymore, one way or the other. So open interest is quite low, and you can tell that just what used to move 3%, 5%, 10% in a day, now it's just not really moving much. But that being said, we're the inventory draw, not just in America with Cushing and the SPR, not just here, but China, right? This is one of the kind of hypothesized reasons why we haven't gotten that crazy move to 200 or 250 is China. Their imports have cratered. I forget the exact number, but it is it is a crash in terms of
Mm,
oil imports for China, legitimate crash. And they had built up huge reserves, their equivalent of the SPR, but for China. They had built that up for this kind of purpose, and they've been drawing that down. It's not really I think a lot of people are mistaking inventory draw for production, right? There's a critical difference between here in America. We got here, pull it up, I think it's like 380 let's see, 380 million, 357 million. We have 357 million barrels in the Strategic Petroleum Reserve. And currently, we did have, going into the war, 415 million. Drawing that down, right, that is for practical oil price kind of purpose. That oil is oil. Oil's fungible, and that oil was brought into the market to fill the hole from the strait, from the shut-in capacity of the Middle East. This oil is oil, right? And so from a supply demand imbalance perspective, oil's oil. The problem here is that production is much different from inventory. Inventory has a limit, right? Currently, we have 357 million. We cannot draw this down to zero.
mm,
Same thing with the commercial inventories. You cannot draw it down to zero. And eventually we have no more inventory. So it's a critical difference, right? Because once that happens, once you reach what they call tank bottom, then there's no buffer. Then there's no fake. I mean, it's not really fake supply, but then there is no more oil, right? It's only what is coming out of the ground, and then that is when the shortfall really becomes kind of front and center. And it'll be any day now, right? Like no one really knows. Some people think it'll be a month and a half. We have summer driving season coming up, and a lot of travel in the summer, and
yeah.
this is kind of
Yep.
historically one of those high demand periods of time. So you have supply that is severely impaired by the Strait of Hormuz, by the shut-in capacity, and Russia, right, has had a lot of attacks on their oil infrastructure too. Now Brazil has ramped up. We've ramped up. Pull up our crude oil production right now, 13.7 million barrels per day here in America, right? So there have been positive additions, but there have been way more negative additions, negative subtractions over the past couple months. So, summer driving season, high demand. Supply is, we're living through the greatest supply shock,
That's
negative
true.
supply shock in history, according to the International Energy Agency. And we're kind of on the sugar high of again, I don't want to call it fake supply, fake because it's not fake oil, it's oil, but it's got a time limit, and once these buffers run out, whether it be in China, whether it be here with the SPR, whether it be our commercial inventories, once you get to that point, then there is no more sugar,
Hmm.
then you get the
Right.
price discovery where supply has to equal demand. And we know supply is severely impaired, at least 11, 12 million barrels per day. That is 9, 10 times worse than 2022. And, during 2022, we got this move in oil. And of course, right after, we got 2 quarters of negative GDP, what used to be a
Hmm.
recession. And we got
What used to be.
a bear market in the stock market. So, um, you know, I'm bullish oil. I think that, whatever it does day to day, like probably not that important, or I got further out calls months out, so I'm just kind of patient with it. I'm not expecting, trying to trade the front month, which is kind of what you're doing with USO. Oops, it's oil exports. Well, look at that. Look at those oil exports for the month.
Whoa.
$17 billion worth of oil exports. Yeah. So, which is good, like
Yeah. Wow.
a lot of people a lot of people try to a lot of people try to make this situation with oil and the war, they try to make it partisan, or they come at it from a partisan place. And I think that's unfortunate because there are legitimate positives, right? But like, for example, this, right, looking at the US becoming one of the largest oil producers, right, in the world. I think that's great. I think that's amazing. I think that, oil and gas, right? I've always pointed out to the people, oh, well, the oil exports will offset the negative from higher oil, negative drag on consumption. I've always pointed out, oil's only like 1% of GDP. I would love to see that go to 3, 4%. I would love nothing more than to see oil, energy kind of writ large,
Mm.
industrial production, mining, right? I would love to see those sectors play a larger role in US GDP and in economic growth here in America. But the reality is they're not yet. It's a 10, 20, 30 year kind of thing. So yeah, there are definitely positives to it. Like, for example, this record amount of revenue from our oil exports. But we're kind of in a point now where we're subsidizing the global oil price via these crazy inventory draws from SPR, from Cushing and the commercial inventories, and then exporting it right to the rest of the world. So we're helping the rest of the world, but drawing down our inventories, right, which are supposed to be strategic in the national interest, right? God forbid there's a natural disaster like a hurricane, for example,
Hmm.
right? Something like that. That's the point of the SPR. So, right now we're drawing it down to help suppress the global oil price, and help Japan and Europe. And, I mean, it's working, right? Look at the oil price. Oil's not 200. So
Yeah.
it is working
That's
if
true.
that's the point. But I think it's a bit short
Have you
sighted
seen?
because, yeah, go ahead.
Have you seen Dark? I think it's Dark Side who's been on Spaces who does think that oil can get to 200. Thinks it will. In fact, I think it's Dark Side's been. I don't know if you chatted with him recently about this topic, or for somebody else.
Oh
Maybe that
no,
I'm
it will.
thinking of.
It will. Yeah, yeah.
You think it will?
It's just basic math.
Yeah.
So the Fed has put out many papers, but this is a pretty rudimentary economic principle called the elasticity of demand, price elasticity of demand, PED.
Mm,
And the Fed has put out numerous papers where they estimate in the short run for oil, the PED is about negative 0.06. So for every 1% that oil goes up in price, you only destroy about 0.06 of demand, right? So what that means is to destroy as much demand as we have to destroy, right? Because it's oil, so supply and demand must be the same. They must come into balance in order to, even if you're very conservative with the disruption and the impairment, call it 10, 11 million barrels, right? Even if you kind of err on the side of caution, you're still talking about, with that level of inelasticity, you're still talking about a huge move in oil. And and again, this is pretty rudimentary economic concept. Now, in the long run, oil is much less inelastic, right? You can substitute, for example, substitutions is one of the reasons. So, for example, oil goes to 500, right, per barrel. Well, you could find, you might probably see Tesla sales jump, right? And EVs. You probably might see electrical bikes, right? I was just in a Best Buy a couple days ago, and they had this whole section for electric, like basically like electric motorcycles.
yep.
It's like these big, yeah. I don't know. I live under a rock apparently,
Yeah. That's, yeah.
but yeah,
My
like
dad's a big
that
bike
kind
guy.
of thing. Yeah, yeah. So that you probably see those start to right, because you don't need oil, you don't need gas, you don't need diesel, and that substitution, right, that destroys demand. That person that might have been a driver, right, with a car or moped or something, they might go, well, it's too expensive. Now I'm just going to ride this e-bike or the scooter, whatever it may be. That is why, in the longer run, higher oil price. You don't need as high of an oil price to destroy as much demand. But in the short run, oil is extremely inelastic. And if you just run the math, again, even being conservative, even erring on the side of kind of, maybe it's not as bad as, people say, and call it 10, 11, 12 million barrel per day disruption. Even if you do that, you're still talking an oil price significantly higher than where we are today. So it's just basic math. In the short run, if that oil supply is not brought back to the market, either one of two things, right? Some people will say, well, they'll never let it get to 200. They'll never let it get to 250. They
Mm,
will, try to engineer a gamma event, right, with options far out of the money puts, and, or what they'll short, they'll print as much money as needed to short the thing and to keep it. You can do that, but then all that means is there will be shortages, right?
yeah.
It is possible that Bank of Japan and Treasury get together and it's not going past 150, right? We will do whatever it takes to cap the price. Well, that's communism, right? Price controls. We
Mm,
know how that works, and that results in a shortage.
yeah.
So either we destroy the demand with a higher price, bring back supply, right? Production, not the temporary supply of inventories, right? That's not durable. That's not sustainable. So either we bring back production, destroy demand with a much higher price, or we get shortages. Those are the only three options. And to try to be optimistic about it, right? Let's say the Strait of Hormuz open today. I think that that's extremely optimistic and kind of
Very.
dislocated from reality given what's going on. But, say you do that. Well, the problem is the shut-in capacity over in the Middle East. It's going to take, a long time to get back up and running. I mean, we're talking month and a half at least, right? To get
Yeah.
that 12, 13, 14 million barrels back. The ships, right? We're talking about a physical thing. Physical oil has to be loaded onto a ship. That takes time. Then the ship has to sail, right, to wherever, Japan, Europe, America, wherever it may be. That can take up to 2 months, right? These ships are huge. They travel at like 9 miles per hour, or 10
Hmm.
miles per hour. I mean, they're very, very slow. Then it's got to be offloaded from the ship, right? And each of the ports only has a given amount of ships that can that it can take at any given time, right? And then it's got to be sent to a refinery and refined, and then it's got, right? So this whole kind of chain link, right? It's like the bullwhip effect, where, you know, even if we were to open the strait today, to get the actual oil into gasoline, into diesel, into jet fuel, whatever it may be, we're talking a long time out, you know, and by then inventories will be depleted, and
Right.
again, the you know, the price will be much higher, just because it's just basic math. It's just basic PED of oil in the short run, which is oil is very inelastic.
Mm.
So, you know, it is what it is. You know, if you'll look at the oil price, it always does this going into a recession. And you know, we have been looking increasingly, especially over the recent past, there's increasingly more and more, I think, maybe not evidence, but more and more of a case to be made that we are late cycle. And
Mm.
you know, this is part of it, right? Look at what oil did going into '08. Oil went from 55 in February of '07 to 135 in June of '08. In fact, the ECB, the European Central Bank, they were hiking interest rates due to the oil spike going into '08. I think they hiked twice. They hiked again this morning. So yeah, this, you know, back here in before .com, back here going into the 90 long-term capital, you know, so you know, you
Interesting.
always get this kind of commodity spike in commodity price. It's one of the characteristics of being late cycle. But, you know, look at what's going on in the speculative kind of, I don't want to say bad words, but you know, the AI nonsense.
Mm.
Look at, you know, we got SpaceX coming up, and
Yeah.
I don't know. There's some
What time is that
definitely
tomorrow
some.
at, by the way?
I'm not sure. I'm not sure, but
So I
you
can
know,
find out.
there's increasingly, you know, you can look at Oracle. Increasingly, I think skepticism, you know, starting to get priced into some of the kind of high flying stuff, and you know, like I think it's warranted. You know, Oracle, for example, you know, recently is kind of one of the good recent examples, down 8%, I think. Let's see, from yesterday's close, 12%. So got
Wow.
SMH up. Yeah, let's check NVIDIA. Yeah, I mean, I don't know. I wouldn't buy this, and I've been saying that. You know,
Mm. Yeah, a
everyone
lot of
was
people
calling
get
me
nervous about
crazy.
this. Yeah, about the equity side right now. Yeah,
Everyone
even
was, oh, what's wrong with you? Stocks only go up. And
yeah,
if you had bought any time in the past month and a half, you're down. And that's assuming it doesn't fall even further, you know?
yeah. A lot of the stock guys have been saying they're like it's still a bull market, which is true. But I think everyone, including themselves, are a little bit skittish around this week as well, and how we're gonna.
I mean, we got inflation, right, running at very, very elevated levels, right? CPI came in yesterday, 4.2. But if you
Mm.
look at producer prices, which came in this morning, 6.5% producer price index inflation, PPI. So final demand came in at the highest level ever recorded for PPI. And that goes back, I think, 25 years. So, you know, inflation is starting to become an issue. If you start to look at the bond market and rates, real rates, Fed funds, or the overnight rate, is now, we now have negative real rates. So you take Fed funds, you take SOFR, you take, you know, 1 month T-bill, very, very short-term debt. The yield there is below inflation. So if you're in 1 month T-bills, if you're in SOFR, you know, Fed funds, overnight markets, you have a negative real rate. 10-year and 30-year, further out the curve, we're still positive, but not very much. 30-year real rate only 1.1. I'll take these other ones off so we can see, that maybe, in the post '08 kind of ZERP sort of era, that might sound relatively okay, normal, to have a 100 basis point real rate on the 30-year, but that's generally not normal. We have more history with the 10-year, so you can see, the 10-year real rate at 64 basis points is very, very low. I mean, post '08, we had kind of the ZERP nonsense, QE infinity, and very low economic growth too. But generally, real rate should be higher, arguably, than 64 bips for a 10-year. So does the Fed start to hike rates? I think that would be a mistake if they did. Because what are they going to do? Print oil? This is not a demand driven. It's not a demand driven inflation, right? This is a supply side issue with oil, and the Fed can't print oil, so they're not going to be able to, you can try to constrain demand, you take rates higher, you take them up to 5% again, you will destroy demand, and you will definitely bring inflation down. But I think that if they hike, it'll be just a guarantee of a recession. I think we're kind of already headed in that direction. You look at real wages, negative, right? Not enough people are talking. I've been talking about this for months now. The real wage story is a huge problem. You look at PCE. I mean, PCE is what, 70% of GDP,
Yeah.
personal consumption, the C in the GDP formula. 69% of GDP is consumers spending their money. And what does that look like? What does that story look like? We know spending is above their income growth for the past 9 months, basically, in a row. That's kind of normal, though, we in America kind of by definition, we overconsume. So spending growing at a faster rate than income, okay, not horrible. But then when your income is growing below inflation, then you combine the two of those and you're starting to get a pretty serious issue. And the only way that this can continue is by drawing down on personal savings, which we've seen personal savings plummet, and an increase of debt. So we can look at the personal savings rate, 2.6%. You're basically very near to an all-time low down here. Back here, for example, in kind of the golden age of America, right? Personal savings rate was 10, 11, 12%, 13, 14 even. We're at 2. So the buffer, that savings buffer, is pretty much not there anymore, right? It's almost gone. You can also increase debt, and we have seen that. We saw revolving credit increase, credit card debt. We saw that increase at 10, 11% for the month at an annualized rate. So, people are drawing down on their savings to very near to a record low. Theoretically, I guess this one could go to zero, personal savings rate, but you have a drawdown on savings and you have an increase of credit card debt and probably non-revolving. I can't remember non-revolving off the top of my head, but credit card debt, revolving credit, definitely huge pop. Well, the problem is twofold. Number one, if you look at the saving side, you don't have much more to dissave, right? Like, we're very near to consumers just not having the money in their saving account or money market, whatever they might, wherever they might choose to save.
Yeah.
Not only are we getting to a point where they're just not going to have the money, but they're increasing their credit card debt as a way to try to fill the hole. But the problem is, you look at the interest rate on that credit card debt, and it's 22, 23, 24%, depending on how you look at it. So it's not tenable. It's not sustainable to continue like this. And, eventually with inflation at, between 4 and 7, call it, eventually people will just have no more money to buy stuff, and like I mentioned with the Fed hiking rates, we can get deflation, and I don't mean disinflation, I mean deflation. We could get there, right? In '08 we got it. And the purchasing power of the dollar actually went up in '08 briefly for like, a quarter.
Or we talked about this in a previous podcast, I think.
It is,
I remember you talking about this.
Great Depression.
Yeah, I see Landy. He said commenting. He said broken structures everywhere. Yeah, a bunch of weird stuff.
Great Depression. The CPI index, because it's an index, it's not consumer price inflation. It's consumer price index. The index fell by 27% in the Great Depression. So we can get deflation. Now I'm not saying we're getting in that amount of deflation, but again, credit card debt, eventually people aren't able to service that credit card debt and pay the 25% annual interest rate, right? Because their incomes are growing below inflation and their spending is growing faster than their income. So, eventually there will come a point where they don't have any more saving. You can't go into more credit card debt because two things. Number one, you can't service your own debt and your credit score is dropping and you're delinquent and right, that kind of thing. They're lowering your credit limit. Or two, the banks aren't willing to issue the credit to you anymore, right? This is kind of further out in the credit cycle, you get that point in time where the banks go, because remember, the private banks print money and they print the majority of the money in the US economy. And they do that by extending a loan, whether it be a car loan, a credit card, a mortgage, whatever it may be. They're printing money when they do that out of thin air, right? Double entry bookkeeping, asset, liability. It's your liability, it's their asset. But they will only do that two things. There are two criteria for them to print money. Number one, there has to be demand for debt, right? There has to be a consumer out there that wants to go into debt to buy the house, wants to go into debt to get the credit card. So there's got to be demand. And then point number two, the bank has to be willing to take the risk, right? And the interest rate is one way to try to kind of mitigate that issue. But there comes a point where the bank just goes, no, we're not issuing more loans. And the spigot, credit starts to run out. And again, they can't draw down from the savings, right? Because it's basically at an all-time low. I mean, it can go a little bit lower, but we're basically there, The last time that we got to this kind of level on the personal savings rate, briefly in 2022, but before that was right before 2008. And here's another one that was if you look at option adjusted high yield spreads, the last time that we got to these kind of depressed credit spreads was right before '08. So people that will say, oh, the US economy is fine, oh, the risk of recession is low, just look at high yield credit spreads, like, well, yeah, it's kind of like, yeah, by definition, they're going to be very tight, reflecting very little risk right before they're not, to me, I don't see it as a convincing argument because, credit spreads are only 250 bips on high yield. Yeah. Like today, but when was the last time they were? And like, what always happens after that? I don't think we're going much lower than 250 bips on high yield, right? And the only other direction then is, well, I guess you could go sideways, but credit spreads widen, and credit risk. And look, like we can look at delinquency data from the Fed, see that student loan delinquencies, all-time high, credit card delinquencies starting to pick up, auto loan. Now, nowhere like '08, right? We are not in a full-blown, foreclosure and, 20% credit card delinquency. We're not there for sure.
Yeah.
This is, I'm talking like people expect everything to happen overnight, in the macro world, and it
These
just
things take
doesn't function like
forever to
that.
play out.
Yeah, it's slow moving, takes a while. But I think that the clear direction is, credit spreads will widen, growth will slow. It's already been slowing going back to
Hmm.
2024. You look at GDP, it's been, down and to the right, especially consumption, which is again 70% of GDP.
Yeah, I think that's probably why these macro analysts don't talk about what comes after, because they know they got plenty of time to kind of I don't even know, like explain themselves out of it, kind of thing. Like when that time comes, if it comes in their head. Um, Also saw a couple of people in the chat. What's going on, Marlins? Good to see you, man. Good to see you again. For those who are in the space or in the stream, by the way, if you're watching, definitely take a second and repost the stream and follow Robert. But by the way, Robert, I do have to head out here. Well, I don't know if this is heading out here early, but I do have to do another show at 10:25, so in about 10 minutes. But yeah, I still got 10 minutes. So didn't know if you wanted to have a look at Bitcoin or if there's anything else specifically that you think we should look at before heading into Friday. But hey, what's up, Saucy? Good to see you, man. Yeah, Robert is a G.
Yeah, I mean,
maybe not.
I've been kind of cautious, when it comes to Bitcoin, given again my view that I just kind of laid out. So yeah, you can't, in my opinion, you can't really hold to you can't hold the belief that you're going into a slowing growth environment and a recession and the Bitcoin is going to go up. I don't think you can hold those views at the same time. At least not yet. Maybe 20 years down the road, Bitcoin is money, hyper Bitcoinization, right? The whole world looks at it as money, kind of like gold. But even gold, right? Like gold has been that for thousands of years, and even gold isn't looked at like money. So again, I'm highly skeptical. I'm highly skeptical of the whole, Bitcoin will be money and very skeptical of that. But say it is 20 years down the road. Right now, it's not. Gold isn't even viewed that way.
I think if it does happen, it would take way longer than 20 years.
Right.
I feel like
20 years.
Like 20 years is a long time, but like I don't know.
For that kind of
like
thing.
Yeah.
So, most of the market looks at it as a, high beta, speculative kind of thing. 3x levered Qs. And given again, like look at the mags. I think, this, I think we double top there. I mean, so far that's what it's showing, right? And so we're at the lowest level for the Mag 7 going back to early to mid-April. Mag 7, we're clearly getting a rotation out of the kind of AI Mag 7 hyperscaler kind of thing. We're clearly getting a rotation out of that. Like some of the past couple days we've actually had today. We'll take today. You got materials up 1.5. You've got industrials up 1.7. And consumer staples a couple days ago was green and everything else was red. So, it's not equities writ large that are I mean, we've had some pretty gnarly days in the past week or so. I think it's more just, I think it's more right now, more kind of an unwind of the dispersion trade where everyone was just mainly the systematic and multi-strat just piling short vol on the index and long volatility on AI names and memory names and that kind of thing. And so implied correlations reached the lowest level on record. That's unwinding. Lowest, I think, is weekly close on record. And, you can tell that that's unwinding. Dispersion is down, implied correlations is up. So there's kind of VAR shock degrossing kind of headwinds or risk. You got oil risk, you got IPO risk for the next week. Tomorrow, kind of. I think going into the SpaceX IPO, you probably did have people, liquidating some of the probably best performing names, right? Like if I was going to buy it, I would probably want to sell the things that were up the most. So, maybe part of what we're seeing in the Mag 7 AI complex is, source of funds for SpaceX as entirely possible. Bond market volatility, not really concerning. I mean, TLT is just kind of hanging out. Like, given everything that's going on in the Middle East, we haven't really had huge move in bonds. Now, the front end of the yield curve, yes, right. We got the 1 year now pricing in 100% chance of a Fed rate hike. So,
Oh yeah, I was about to say. Marlon asked, "What are the odds of a Fed hike now that the
20,
ECB
yeah.
just started
So
hiking?"
the 1 year is 29 bips above Fed funds. So there is 103, 4, 5, 106%. I don't know. I'm really bad with math. But at least 100% chance that that the bond market says that the Fed will hike over the next 1 year.
Wow.
So, you
There you go.
can throw that into the mix. I don't think that's especially bullish. You look at like 2s 30s, 2s 10s, and the curve has been flattening like really significantly, which is not a sign of a reaccelerating economy. So, you look at GDP, the growth backdrop, I think is pretty poor. You have inflation the only cure for high prices is high prices, whether that be oil, whether that be, I don't know, whatever people are buying, with CPI, PPI, right? Inflation, like eventually inflation will get so high that people just go, I can't afford it. I'm not buying it. I'm not going on the trip. I'm not buying the
Right.
the tank of
They're not
gas
gonna
to
have a
go on the road.
choice. They just literally can't.
Yeah, you
It's
just
just it's just
literally,
gonna be like a
there's no personal savings left, and their wages are running below inflation, so they're losing purchasing power, right? it
yeah.
it would be equivalent to, if inflation was zero, it would be equivalent to getting a pay cut, right? Right now of
Yeah.
about 1% per year. If inflation was zero, which is definitely not, but just imagine no inflation in the world, you're getting about a 1% pay cut. That is a much bigger story than I think very many people are talking about what's going on with
Yeah, I think
wages
so.
like that.
Yeah, I see spiders in the chat. He says a lot of sideways action. Marlon, let's hope AI will act deflationary. Yeah, we'll see what
Yeah,
happens.
that's kind of another deflationary force.
Yeah.
You got China potentially slowing down really significantly. With the oil thing, it's like, okay, look, if you believe that the decline in oil imports is real demand destruction and not just due to an inventory draw, well, that's pretty bearish, right?
Hmm.
And you look at some of the eco data coming out of China in the past month, is pretty bad. So, you got that, you got AI potentially causing deflation, not only in the labor market, but also, look at token costs over the past month, down. So you got OpenAI talking about, significantly, dramatically cutting their prices to compete with Anthropic.
Hmm.
That kind of
Game
stuff.
theory, baby.
Yeah, it's becoming much more of a commodity. And so, there's the whole AI bubble in the equity market. Once these kind of deflationary forces start to work in, and that starts to unravel, you see a huge destruction of wealth in the equity market. Those equities are collateral for leverage. There's I think now they're not going to allow a Great Depression, right? Like, I hope
Right.
people don't misunderstand. I'm not, I don't think that we're going into a Great Depression or anything, but I do think that, like, on balance, over the next 12 to 18 months, the risk is significantly tilted to the downside. And so, cash and look, cash is right now getting negative real yield,
Hmm.
so my TLT is not. My TLT is outperforming inflation by 1.1. So this is the kind of time, and of course TLT in the long end duration, you get convexity, so there's that. But yeah, kind of all in, cash at current rates, you're losing money, about half of 1% per year to inflation. But further out the curve, you're still getting real yield. And just kind of wait. Like my TLT call options are a year away.
I was gonna say they're at least a year out, right?
Yeah, so I'm getting 5% on my TLT shares and just kind of waiting and
pretty good.
Waiting for the inevitable, I think.
I was gonna say this would be potentially a legendary moment to look back on when you got into those trades and started talking about them in about a year when you're able to look back on these streams. But
yeah, and this is why I think it's really important for people, like, you look at what's going on in Kospi, for example, right? This is why it's really important not to chase. Things were just getting crazy. They were just getting ridiculous. You had people in South Korea liquidating their life insurance to go levered long with margin. People were overdrafting their checking account, calling it a loan to go levered long, some 3x SK Hynix. I mean, and like if you bought at, you're down 13%, cash cannot go down. No, I mean, it can go down to inflation, but again, we established you're losing 50 bips to inflation, not 13%. And I'll just end by saying or reminding people that right now the equity risk premium is negative, meaning the S&P 500 earnings yield is below the 10-year yield. So why are you going to take an enormous amount of risk in the equity market, as we can see, Kospi down 13%, Mag 7 down, I think, about 10% from its high. That you're the potential for that kind of drawdown and even further drawdown, you're taking all of that risk for what yield? Well, the S&P 500 earning yield is below the 10-year treasury yield. So risk-free U.S. Treasury,
less return, higher risk,
and the 10-year Treasury is yielding a positive real yield, still barely, but it's still positive, right? So you're beating inflation. It's risk-free, at least currently, right? It's not always, but at least right now. Why? Like, I don't get it. Why would you take the enormous amount of equity risk? People forget when you buy an equity what you're actually buying, and I think and that equity, that discounted future cash flow, is discounted by the 10-year Treasury yield. And what has the 10-year Treasury yield been doing due to oil? So yeah, I would just
yeah. No, some great points. And I appreciate everyone who's in the chat here as well for jumping in here. Look, anytime anyone's in the stream gives us any questions or thoughts, you can always leave us a comment in the chat here and let us know. Hopefully you guys enjoyed the stream. Dude, Robert's a freaking machine. You guys should hear about his schedule. He's a freaking machine. So
I've been up
be sure to follow him. Yeah, brother does not know sleep. He has not met it. Give him a follow on X. Subscribe to his YouTube. He just posted a video, actually. So definitely check out his stuff if you enjoy these kinds of content. He puts out a lot of it. He's on Spaces all the time, on our Wolf Spaces, as well as many other big spaces. So give him a follow so you don't miss him on the next one. Otherwise, guys, we'll see you guys in the next one. Again, big shout out to Public for sponsoring the show today. If you guys want to check out this platform, there's going to be a link below on YouTube in the description. And if you're on X, it'll be in the tweet below the stream. Definitely check them out. Big shout out to Public as always for sponsoring the show. They're a great platform, great brokerage, and we're excited to be working with them. Got a bunch of stuff cooking for 2026. We'll see you guys all in the next stream, everybody. We'll be back on Spaces in about half an hour. And yeah, man, we'll see you in the next one. Take care.
See you guys.